Hello, I'm Mark Patton. During this workshop, I'm going to discuss the performance of super diversification during the second quarter of 2018. I'll also provide some longer term perspective, both looking at the year to date performance as well as some longer term numbers going back to the inception of super diversification 8+ years ago. This workshop is intended for both our existing clients as well as prospective investors, those who are considering super diversification. I hope that all of you find this content both informative and helpful. Um, if you have any questions at any point in time, I know a lot of folks will listen to this via the replay. So if you have any questions at any point in time, you can always go to our homepage that's displayed here on the screen. My email address is up here in the top left-hand corner. Our phone number is up there as well. And you can also click on Ask Patton, and you can fill out your name and contact information as well as a message and click Submit, and that will go directly to me as well. So anytime you have any questions at all, please feel free to let me know, and we'll absolutely respond to you and make sure that we address anything that you'd like to hear from us. So with that, before we dig into the performance of super diversification during the second quarter, what I'd first like to do is provide an overview of super diversification, just as a reminder for those of you who are our clients as well as those who are considering investing in super diversification. So I'm going to go from our homepage under Why Patent and go to our portfolios and just take a little quick review of super diversification. So number one is we do believe super diversified portfolios are better than other portfolios in that typical portfolios are diversified across traditional stocks, bonds, and cash, where a super diversified portfolio includes investments in other things that provides more diversification and provides what we think is a better portfolio long term. We'll demonstrate a little of that in just a few minutes. Super diversification is meant to be a total portfolio solution. It's not meant to be just one piece of a portfolio, but it's a total solution for an investor's portfolio. And super diversification, very important, it's built on what we call math that works. Diversification is determined by certain mathematics around different investments, and we utilize those mathematics to build each one of our super diversified portfolios, and we believe it's that math that has produced the very strong results that we've had the last 8 years and will continue to do so going forward. So we believe it's built on what we call math that works. One of the other things about a super diversified portfolio is that we utilize many low-cost index funds. This is one way in which we keep costs low, and keeping costs low produces higher long-term rates of returns. One way that we do that is through low-cost index funds. Another common characteristic of almost all of our super diversified portfolios is an allocation to our proprietary flex strategy, which is our hedging strategy. Our flex strategy is expected to produce above average rates of returns, which it's done for the past 8 years, and it also helps mitigate some of the risk inside of a super diversified portfolio. So it's really a very important component to an overall super diversified portfolio in producing some of the success that we've had. I also like to remind people that super diversification is built on the success of others. I'm not the one who invented the premises or concepts of diversification. It's been going on for a very long time. And there are others out there that have been utilizing the same mathematics that we talk about and that's built into super diversification. There are others who have been utilizing these same principles in math for multiple decades, improving the success of these principles. And it's these principles that we've incorporated into super diversification. So we call that being built on the success of others. One last thing is to point out is that every super diversified portfolio can be customized for each one of our individual clients. So when we talk about the performance today, it's going to be a representation of our most common portfolio allocation, which is going to be a more growth-oriented allocation. But that only speaks to some of our clients. We have other clients who have different risk profiles, who will have different super diversified portfolios allocated differently. So it's very important to understand that every client can have a customized super diversified portfolio based upon their risk tolerance and their investment goals and objectives. Let me show you a visual of what I mean by a better portfolio, just to quickly summarize that. So we've got a new section of our website, our presentation page, and we've taken all the content and all the topics of super diversification and separated them here into these different meaningful pieces. But the first one would just be building a better portfolio. And I just want to visually show you what I mean by that. So for me, as most of you know, it's all about this dot. It's a scatter diagram. It's the expected return on the left-hand side and the risk profile across the bottom. So when I talk about building a better portfolio, it's about helping somebody understand where their level of risk is. How much risk do they want to take? Low, medium, or high, or somewhere in between. And then trying to figure out how do we maximize the rate of return for the amount of risk they want to take. So for example, you take a low-risk investor. That would be over here on the left-hand side. A traditional portfolio might have a lower expected rate of return, where our goal is through super diversification is to have a comparable risk profile moving straight up. So the same risk profile, but a better expected rate of return. We would do the same thing for an investor who says, I want to have a moderate risk profile, but it's going to be a different portfolio allocation. But the goal is it'll produce the same risk profile as a traditional moderate portfolio, but with a higher expected rate of return through super diversification than the same for a growth-oriented portfolio. So ultimately, our goal is to maximize the expected rate of return for whatever risk profile or risk tolerance somebody wants to have or take. That's what we believe a better portfolio is all about. Let me visually show you what makes a super diversified portfolio so different than a traditional portfolio, because sometimes we look at these different portfolios, they don't look all that different to us, but when you really drill down, they very much are. So on the left-hand side, I have a super diversified growth portfolio that we're going to talk about, and a traditional growth portfolio. We can click on this Show Table button. Now, this is on a page called our Super Diversification Additional Performance Data. This is all accessible via our public website. But if we click on this Show Table button, it's going to bring up a table showing us the asset allocation, how these two different portfolios are allocated across different types of investments. So you have the type of investment or asset class on the left, super diversified portfolio here, and the traditional portfolio here. So you can see, for example, under U.S. stocks, that the super diversified portfolio is only allocated 18% to U.S. stocks, while a common traditional growth portfolio is going to have an allocation of closer to 60% in U.S. stocks, a very different portfolio allocation. When you look at international stocks, we're going to be allocated across both developed and emerging markets. Developed would be like Europe, Australia, and Japan, and so forth. And then emerging markets are Brazil, China, and so forth. You'll see we've got allocations across both of those in our super diversified portfolio, and we often have a larger allocation to international stocks than in a traditional growth portfolio. And then it's really these alternative asset classes, or we can call them non-traditional asset classes, that really makes a super diversified portfolio different than a traditional portfolio. So you can see in our super diversified portfolio, we include an allocation to commodities, gold, real estate, Berkshire Hathaway, which is Warren Buffett stock, and here's our proprietary flex strategy, our hedging strategy, typically 30 to 35% in many of our clients' portfolios. So across the alternative or non-traditional asset classes, you'll see a total of 56% of the entire portfolio of a super diversified portfolio is in these alternative asset classes, and a typical growth portfolio typically has none of these things. That is what really makes a super diversified portfolio so different than a traditional portfolio. And then to finish it off is down here at fixed income, which is also another term for bonds. You'll see we tend to have a lower allocation to fixed income or bonds because the diversification that we get in our portfolio comes from these other asset classes, so we need less bonds in our portfolio. The bottom line, though, is we're investing a super diversified portfolio differently than a traditional portfolio, and as a result, we will get different results. Over time, we expect those different results to be better than a traditional portfolio, and on average, that's absolutely been the case, but there will be shorter windows of time when a super diversified portfolio will lag behind a traditional portfolio, and unfortunately, we're going through one of those times right now, which we'll get to in just a moment. But I just want to make it clear that these portfolios that we've built, these super diversified portfolios, truly are different than the traditional portfolio that most investors have seen in the marketplace. So with that, let's move on and talk about the performance during the second quarter. So I'm going to go to another page of our website. This is only accessible via username and password. So when our clients log into our website, it typically defaults them to this page. We call this the Super Diversified Portfolio Statements section of our website. This is where we present performance results updated daily for our clients, as well as a lot of other information about their portfolio. This is a sample super diversified portfolio. I'm currently looking at what we call the performance summary report. I'm going to jump down and I'm going to look at the holdings report and show you that this portfolio is you know what, I've been logged in for too long. Give me just 1 second. You can see exactly how we log in. Go to our home page and you log in with the custom username and password that we provide, and it'll take you directly to our super diversified portfolio statement section. I'm going to drop down to that holdings report, and you're going to see how this portfolio is allocated, and it's our typical growth portfolio. So under U.S. stocks, you'll see under the target allocations, we have a total of 18% there. International stocks, a total of 16%. The alternative asset classes, this particular portfolio is only at 51% and not 56% like we saw before, but very, very, very similar. And the bond piece is at 15% with zero in cash. So this is a very common super diversified growth portfolio. Let's take a look at the second quarter performance. So to do that, the easiest way, I'm going to drop down to the month-by-month returns report. And I'm going to drop this down so we're only looking at the most recent quarter. So we'll go from the end of March. There we go. So we now have April, May, and June. The blue bars represent the super diversified portfolio, and down here in the table, we have that under the heading of what we call family. So for our super diversified clients, they might have multiple investment accounts that are managed as one family or a one family portfolio. So we call that the family, but that would be the super diversified portfolio anytime you see the word family here in this section of our website. And then over here, the next column is benchmark, and this is going to be that traditional growth-oriented portfolio that we were looking at. So this is what we will benchmark the performance of super diversification against, is this traditional portfolio. So during the second quarter, it's been relatively and unfortunately disappointing. April was a down month for both portfolios, but meaningfully more so for the super diversified portfolio, down 1.9 and some change versus about 0.25% for the benchmark portfolio. May was a positive month, and they were comparable, but still we underperformed a little bit at 1.6 versus 1.77. And then for the month of June, a disappointment as well, down 2.6% or so, and down 0.2% for the benchmark portfolio. So the second quarter was certainly not ideal for super diversification. And again, when we invest a portfolio different than a traditional portfolio, we're going to get different results. Longer term, we've produced great long-term success. We believe that will continue, but during a shorter window of time, this just unfortunately happens. It's just the nature of the beast. We will take a look at what asset classes in the portfolio have been impacting the performance during the second quarter and year to date. So with that, let's take a look at the year-to-date performance, and it's been equally disappointing, quite honestly. The easiest way to do that is to drop down and look at the year-by-year returns report. So for 2018, that will be year to date through June of 2018. So we go down here to 2018, you'll see the family, which again is the super diversified portfolio, down 2.35%, and that benchmark portfolio has only lost 0.25% during that same window of time. So we've underperformed by about 2 percentage points. Again, that's a disappointment year to date, and I don't like it as well as anybody else does. But again, it's just very normal behavior for super diversification, and we clearly expect that math that has been working for the past 8+ years to continue to do so. You can actually see that historically here, a longer term picture here year by year, and more often than not, certainly the super diversified portfolio in this family column has much more often, more frequently done better than the benchmark portfolio. Not always, but the odds have clearly been stacked, and we think they continue to be so stacked in our favor. Let's take a look now at the asset classes, the individual investments in the portfolio that we have to see what's been driving performance. I'm going to go to the asset classes report, and I'm going to drop the start date down to March 31 and we'll go to June 30. So that would be the second quarter. So we can see this table listing each one of the different asset classes in that super diversified portfolio, U.S. large, mid, and small, and so forth. But we can see a graph down here that's a little easier to look at. So you can see again, U.S. large cap, large stocks, mid-sized stocks, small U.S. stocks, international developed countries, and internationally emerging, commodities, gold, real estate, Berkshire Hathaway, again, Warren Buffett stock, our flex strategy, which is our hedging strategy, and U.S. midterm government bonds. So you can see very quickly by glancing at this graph what's been driving performance. So clearly U.S. stocks have been doing very well during the second quarter, led by small cap stocks. Small stocks are up almost 8% just in the second quarter, a very strong quarter for small stocks. Large and mid stocks have lagged behind, but still a positive performance, but very attractive. We look at international stocks, it's been a disappointment. In particular, internationally emerging markets like China, Brazil, and India, and so forth. Those markets have been hit pretty hard, down 9% on average in the second quarter. International developed markets like Europe and Australia and Japan and so forth are down, but not nearly as much, down about 4%. commodities have been higher, that's predominantly been driven by a higher price of oil. So the price of commodities has helped the portfolio, up 7.8% for the quarter. Gold has been negative, low inflation, no fears about inflation, really kind of keep gold prices low, and we're seeing that again in the second quarter. Real estate had a nice recovery back. It was a very rough first quarter for real estate, and a nice rebound here in the second quarter, up better than 9% in the second quarter, very much helping the portfolio. Then down here at the bottom, we have Berkshire Hathaway, Warren Buffett stock down about 6.5%. Our flex strategy down about 7%, very disappointing, and U.S. government bonds during the quarter down less than 1%. So we can very quickly see, what's driving performance. And quite honestly, this picture looks very similar when we look at the year-to-date performance. So if we start this on 12/31 of 17, you'll see the graph really looks somewhat similar. U.S. stocks doing well, international not. There's commodities and gold again. Real estate about flat because they had a down first quarter and up second quarter, so about flat for the year. And then Berkshire Hathaway down a little less than 6, the flex down a little less than 5, and bonds down almost 3%, which is a pretty big move for bonds as the Federal Reserve continues to raise interest rates. Assuming they do, that will likely put some downward pressure on bond prices as yields go higher. So anyway, that gives you an idea of what's been driving performance both in the second quarter as well as year to date. Very similar in both periods, except for really real estate. Second quarter was strong. Year to date has been basically flat. Let's take a look at some longer term numbers just to wrap up here. So there are two different ways we can do this. We can look at the risk return report, probably my favorite. This is the scatter diagram again. The dot, the return on the left axis, and the risk across the bottom. The blue dot represents the family, and the green dot represents that traditional benchmark portfolio. So the blue is the super diversification. Down here in the table, you can see the family or the super diversified portfolio has compounded annually during this 7+ year window of time at just under 10% compounded annually, 9.9%, as compared to the benchmark at just over 6%. So almost a 4% compounded annual improvement in the actual rate of return during this 7+ year window of time. So we are very, very pleased with the long-term results. We recognize we're going to have shorter windows of time, like the second quarter and like the year-to-date numbers, that will be disappointing, albeit not all that much, a couple percentage points. Long-term, we will take some of those short-term disappointments for the long-term success that this clearly is demonstrated here. And in addition to that, you can see the risk profile. We'd prefer the blue dot be over here to the left, but it's not. So actually, this is the super diversified portfolios had a little bit more volatility than the traditional portfolio, but it's really relatively small. Both of these portfolios have experienced very low volatility. So you could argue these are very comparable in risk, and the return has been just substantially higher with the super diversified portfolio. One other way to take a look at this and to put it really in perspective is to look at the cumulative rate of return of this super diversified portfolio, and we can do that with this report called Comparables Trends, and this will show us a line graph of these portfolios as well as the S&P and 500 and bonds. So we're going to focus on the blue line, which is the family of the super diversified portfolio, and the benchmark portfolio, which is that gold or yellowish line. And this is the cumulative rate of return starting off at 0 back at the inception date of May of 11, a little more than 7 years ago. And you can see that this super diversified portfolio has produced gains of a little more than 95% cumulatively during that 7+ year window of time. And you compare that to the traditional benchmark portfolio at about 51.5% cumulative gain during that same window of time. So the difference of getting a 3 or 4% compounded annual better rate of return, as we saw in the scatter diagram, over time can add up to a huge improvement over longer periods of time when we look at the cumulative rate of return. With the super diversified portfolio, pushing, nearly double the amount of gains during the past 7+ years as compared to that traditional portfolio. So we are very, very pleased with the long-term performance of super diversification. We believe that the math that has been driving the long-term results will continue to drive the long-term results. There's absolutely nothing that would indicate otherwise. Short-term disappointing performance like we've had in the second quarter and year-to-date is very, very normal. It comes with the territory, and there's absolutely nothing that is telling us that there's anything wrong with the model and wrong with the strategy and wrong with the math. This math has been working for decades, and we expect it to continue to work for decades. So we remain extremely optimistic. A couple things I'll wrap up with. One thing is these workshops that we do are all accessible under services and workshops. You can see the upcoming workshops on the upcoming workshops tab, of course, and then you can see the replays that are available here, including the one that you're listening to. So those are our workshops for continuing education. In addition to that, we have what we call our Learning Center. This is a newer piece of our website, and these are various topics on super diversification, on our flex strategy, on investing in general, and these are typically short videos, somewhere 3 to 10 minutes in length, on various topics. So we think that these will be great tools for folks to digest a little bit of information in a short window of time on these various topics. You can filter these topics here as well. And if you want to look at the super diversification, there are the 5 different items under super diversification as an example. And the last thing I'll say is our blog is out here as well. So this is, there's a weekly market commentary that I do. If you read the Wall Street Journal every day, then this is not going to be of value to you. But if you don't read the Wall Street Journal and you want to stay up to date on what's going on in the market, and you want to have some information on some of the biggest moving stocks and so forth, you can get that here via our blog. So this is a graph of the different asset classes that we talk about. So you can see this on a weekly basis. I have some commentary down here giving you the weekly and the year-to-date performance and some other information. Then I highlight a few stocks. Not that it impacts our investing at all. It doesn't. It's just to keep us informed about what's going on with some of the leading companies out there and the biggest movers out there in the marketplace. And then down at the bottom is some economic data. So any of the key economic reports that came out will be highlighted here as well. So we hope that you find that to be a good tool to simply keep you up to date and informed of what's going on in the marketplace. Again, if you have any questions at all at any point in time, again, our phone number and my email address is up here at the top of the page. You can always go to the Ask Patton page and put in your contact information and your message and send that to us, and I will get that email and we will respond. So I want to say to all of our clients, thank you very, very much for the opportunity to be of service to you. And for those of you who are considering super diversification, we'll be happy to do whatever we can to be of service to you and help you in any way that we can. Feel free to reach out to us, and we're glad to have a conversation. So with that, I want to say thank you for your time, and I hope this has been informative. Take care.